My name is Donna Rapiccioli, and I have the privilege of serving as the Dean of the Gabelli School of Business at Fordham University. Welcome to today's webinar, which is part of our Centennial Webinar Series. Thanks to everybody for joining. I want to thank our co-sponsors, the CFA Society of New York and the Museum of American Finance. I also want to give a special thanks to Andrea Manillo, who will host today, as well as our guest speaker, Domenico Salascalco. 2020 marks a 100th anniversary for Fordham University's Gabelli School of Business, 100 years of purpose-driven business education. Our year started with an event with PVH, celebrating a historic partnership with them around sustainability. In March, we hosted a conference, Work 2040, the future of work in a sustainable world. And though our world has changed a great deal since then, we have decided to continue sharing thought leadership using this Centennial webinar series. I'm very grateful to Andrea for thinking about the series and for calling on so many of his good friends and colleagues to share their thinking with us. I want to again recognize Andrea. He was a founding partner of IDA Capital in London. He's a member of the Gabelli School Advisory Board, and he also is the chairman of the Fordham University London Center Board. To learn more about our Centennial events, please visit our website, fordham.edu/Gabelli100. I also want to bring to your attention that many of our students are facing serious economic challenges due to the healthcare crisis and loss of internships and jobs. Our university is also facing some financial challenges. So I ask you today to please consider making a generous gift to the Gabelli School. You can do so by visiting our website or using the link that will be sent to you after this webinar. But now, I really want to bring to your attention our very special guest, Domenico Salascalco. He's a managing director and vice chairman of Morgan Stanley Europe. He's an Italian economist, and he's the former Italian Minister of Finance. He's also an author and an academic, and he is going to share his insights on the new Europe and the future of Europe. This is an incredibly exciting opportunity for all of us to learn more about what's happening in real time. During today's webinar, please type your questions in the Q&A section near the bottom of your Zoom screen, and our speaker will be answering the questions. But first, Andrea Manillo is going to frame the discussion, so please let me turn it over to Andrea.
Thank you, Donna. It's a personal great honor to have Professor Domenico Salascalco with us today. We've been acquainted for over 20 years, maybe 25. It has been one of the most brilliant and innovative European economists in the last 3 decades. Domenico, in his career, has been both a passionate academic educator and an accomplished civil servant. He has been internationally educated in the most prestigious university in the world when he eventually went back as a scholar or lecturer, and as an educator has been greatly appreciated by students, making his advanced courses very successful and enjoyable. He became Director General of the Ministry of Economy and Finance of Italy in 2001, and a few years later is sworn in as Secretary of Finance. Under his tenure, he laid the foundation for the most important tool for the Italian economic policy. And Cassa Depositi e Prestiti, CDP, eventually shall become the largest European sovereign fund. After his service as Minister of Finance, Domenico joined Morgan Stanley, chairing the institutional business. I have never had the privilege and honor to work with him because while I was in the corporate world and my first bank was Morgan Stanley, he was not there. And when I joined the CDP, he had left his service, and I merely executed, hopefully pretty well, for my country what was drawn by his brightest mind. Domenico will be the first former Secretary of Treasury to celebrate the centennial of Gabelli School, and it shall be followed by Tim Geithner in few days. So Fordham community shall have the tremendous privilege to listen to two of the most brilliant and sharp minds in the financial world. No.
Thank you, Andrea. As I told you just before this conference, you are always too kind in introducing me. But let me tell you, it's sincerely a great privilege for me to hold this conversation with you on the future of Europe and possibly the next European decade, because I believe that many things are changing in Europe as a consequence of the coronavirus pandemics, and not all for bad. Some could really mark a fundamental change in our way of, in our political architecture, our way of doing business, etc. So all in all, I'm more optimistic than pessimistic, but let me tell you why. The argument is pretty simple. I will say that the virus pandemics and the economic consequence of it have been pretty symmetrical across countries. But what is different across country, what will be different across country is the shape and the timing of the recovery. Because some countries are putting in place different policies with possibly different impacts. What is unique in Europe, however, is the European intervention, which goes beyond the national intervention. And I will try to argue why it's very interesting over and above the immediate economic impact and what will be the consequences. Let me start by giving an argument why the coronavirus pandemics and the health response have been pretty symmetrical across Europe. If you simply correct for a different start of the epidemics in different countries, you find a very similar shape in the diffusion of the infection, as well as hopefully in the decline of it. The strategy to address and contain the infection, even if, again, it started a bit differently in different countries according to the recognition lag that happened in many countries, has been equally similar. And it was a bit old-fashioned because it reminds what we did in 1918 with the Spanish epidemics. It's fundamentally social distancing and lockdown, which means to lock people at home and keep them apart. So not very sophisticated in a sense. The negative impact on our economies, however, was even if symmetrical across country, very different than from the past, because the world economy was much more interconnected through supply chains, through globalization, etc. And so the spread of this infection has been much, much faster. What is not symmetrical, as I was saying in my short introduction, is the shape and the rapidity and the swiftness of the economic recovery. Many people claim it's a V shape, and the latest US data seem to confirm this view. Other people claim it's a W, so with the chance of a second wave of infection, which seems to be less likely than it used to seem, say, a month ago. And many other people believe the recovery will be much slower than the drop, and it will take up to 2 years. What are the main policy response economic policy response to the crisis? Well, first of all, you have to distinguish the time horizon, because there has been so far a massive intervention to provide the bridge to the recovery. This bridge to the recovery fundamentally is based on liquidity. Central banks flooded the economy with liquidity, but also partly on fiscal policy. On the other hand, it's very interesting also the long run response to the crisis, because while in some countries, like the US, the long run response is being left to the market. Once you provide money to the economy and you select companies which are viable and solvent, companies which are viable but not solvent and need restructuring, and companies which are not solvent and not viable and need to be closed, but then there is not much planning. While in Europe, there is a lot of discussion around what to do. A big investment plan for infrastructure, a big investment plan for broadband and new technologies to reinforce the technological jump and the organizational jump we already did these days, et cetera, et cetera. The problem is that whether it is purely short run or whether it encompasses the long run policy I was saying now, in many countries there is not enough resources because the public debt as an initial condition is very high. Think of Italy, where the public debt was 133%, and also many countries don't have access or will not have access or could not have access to the global capital markets, and therefore need support either by central banks, which in Europe is already a European institution, but also by Europe as a whole, because the resources involved into this recovery plans are honestly huge. What is the main response in Italy? In Italy, we had a banking guarantee scheme like anywhere else in Europe, plus support of incomes for the less favored part of the society. So no one actually starves or is thrown in the middle of the street, so to say. But apart from that, there are these huge investment plans which are still under discussion and again will require European resources. Europe from the very beginning realized it was time for a common approach. I don't call it solidarity because it's not solidarity but common interest. Call it the way you want, but we have 5 main legs of intervention. One is ECB, which came in 2 subsequent waves of support to the economy. The first one was 750, so was the second one. So we have 1.5 trillion euro, $1.7 trillion, so to say. Then there is the ESM, which is the European Stability Mechanism, which has been completely redesigned. It was designed originally to address the idiosyncratic crisis in public finance, like the Greece, Irish, Spanish intervention are well known. Now it has been redesigned to address the needs of expenditure in the health sector, direct and indirect consequences of the crisis. There was a heavy conditionality which was taken away, but there is still a debate in different countries whether to activate or not, whether to ask or not for this facility. Then there is SURE, which is the European support to the national layoff schemes. Then there is EIB, the European Investment Banks, and these are all more or less already existing facilities. While on the contrary, what is really new is this Next Generation Europe, or as we say in common language, Recovery Fund. This initiative grew out of Merkel and Macron combined effort. It was a revolutionary proposition because for the first time it envisages Eurobonds as financing tool, which means bonds issued by the European Commission, which don't appear nor burden the national debts, the national public debts. And also it gives grants for 500 billion out of 750. So it's huge, it's important, it's there to finance the long run, not the bridge to the new normal, but the next development model. But more importantly, or at least equally importantly, is crucial from the European architectural, institutional viewpoint, because Europe typically grows out of crisis. It grew up the last time in 2011 and 12 when Draghi made the famous speech on whatever it takes. And now this is another crucial thing, because it gives Europe a more substantial budget. It gives Europe the possibility to issue bonds for a specific tool. And therefore, it's a crucial step forward. This is important for politics, as I was saying. It's important for economics. It's also important for geopolitical issues. And I'll conclude on that. Over the last 24 hours, I've been talking to the State Department in the US, as well as on a think tank in Washington, the Peterson Institute. They both recognize that the US needs Europe to deal with China, and China probably needs Europe to deal with the US. So this creation of a new European approach, together with the amount of resources we put into play and the mechanisms, can pave the ground for a European decade, which I hope will come true, even if, to be honest, the devil is always in the details. And so we'll see the way it will develop over the next few months, because nothing has been approved yet, and it will require a lot of attention to micro mechanisms to distribute these resources. I stop here. Thank you.
Domenico, thank you. Before going back to a crucial point, the political and geopolitical impact on that, can you tell us something more about the fiscal tools which will be put at disposal of the countries, and if the policy, the UE policy discussion, have an agreement on that?
Yeah, since the crisis of 2008, most of the economic policy to address the great financial crisis, as well as this one at the beginning, were monetary policy. Non-conventional monetary policy, which means the purchasing programs of securities, TARP in your country, QE in Europe, etc. And this somehow created a sort of Dutch disease for fiscal policy, which was not needed. When we entered this pandemic, we quickly realized that we could not rely only on monetary policy, because they ran out of dry powder, because the budget of ECB, which, by the way, had not been shrunk like the budget of the Fed, was too big already. And so we started thinking about fiscal instrument. What is the fiscal instrument put in place? Of course, there is this SURE, there is this EIB, there is this ESM, which will provide money to countries according to their applications. And then there is this global, not global, but I mean recovery fund, which will be loans and grants. Loans will be 1/3 and grants will be 2/3 given to countries according to their request and according to their national plans. And that will be the only conditionality. And there comes the big difficulty, because, you know, giving out money in that amounts requires a lot of attention to the mechanisms, as I was saying. In Italy, we basically committed 80 billion to the short-term of national resources to the short-term recovery. Very little arrived yet so far to the firms and to the consumers. And these mechanisms will be key in the next wave of European programs. The example of the cohesion funds is not encouraging, because usually they are not spent. in my country, but because these are left to the regions which are somehow clumsy in building the regional plans for investment. In this case, at the European level, it should be better. There are also centralized plans like the investment in infrastructure or the investment in the broadband. So we'll see. A final remark concerns the funding or the repayment of the debt. The debt will be long run. The European debt, I mean, will be long run, 8 to 30 years. It will be repaid in due course for whatever is not bought by the European Central Bank. So we'll see, but certainly we'll need a lot of attention because these mechanisms, which are entirely new in our countries, lend themselves to a lot of misinterpretation, particularly by the frugal countries that are against this kind of windfall money to the Southern European countries. So it will be a big test for Europe as well.
Well, before going to another substantial question, may I pick one of the questions that from the attendees that I found very relevant regarding what you just said? Do you see any threat from the court case on the ECB stimulus plan?
Not really, because the ECB intervention was put in play, so to say, or heavily criticized by the German Constitutional Court about a month ago. In Karlsruhe, they said, they put a lot of constraints to the Bundesbank intervention, and they even challenged the European Court of Justice, who had already ruled positively on the QE. By the way, the challenge was not on the current coronavirus purchasing plan called PEP, but it was on the previous one, but it's easily extended. What ECB decided to do has been to play hard nose to the German Constitutional Court, shrug it off and continue and reinforce the plan. So I believe that currently the German Constitutional Court put themselves in a corner, because if they continue on the same line, they could even force a breakup of the euro from the German side, which is far beyond their jurisdiction. If they don't, they will be somehow not humiliated, but bypassed, losing some credibility. So I believe that now the ball is in European field, and Europe played very well.
Donna, you have a question, I suppose, that I...
Yes, I was going to ask about the regulatory environment and MiFID2. One of our professors is asking you to reflect on that and how it might hurt attempts to spur the economy. And I was also related to that, was also interested in, what is the timeline? A decade, 10 years, but what are some of the things that we might see happening that we will know that we're on the right track? So 2 questions, one about regulatory initiative and another about timeline.
Yeah, at the moment, even if Europe vis-a-vis the US has this more interventionist policy stance, I believe it's not the timing of regulation. So I don't see environmental regulation to play hard in many areas. Same thing on the banking side. If anything, they relax the regulation as well as in many other areas. What's interesting to note, however, is that this next generation, I mean, as you know, Europe is a non-homogeneous area. There are countries in the north who have issues and preferences, hardcore countries like Germany and France that want to build a stronger Europe, countries in the south who have different issues. So the plan has been crafted somehow to meet the needs by all the different groups. If you take this 750 euro, billion, of course, it's 250 is loans, but even the 500 is 310 goes to the countries that were hit more severely by the crisis, 50 go to the Central European countries, 120 go to digital and environmental investments. So it's not regulation, but it will be constrained to go to that thing, and 20% goes to the Balkans. So it will be managed that way. How quickly will it kick in? Being the long run or the medium run response, I expect them, and being, I forgot to say that, and being tied to the European budget 2000, that starts in 2021, will start next year. So you'll see the other programs to kick in almost immediately. Countries could apply for the ESM immediately, could apply for SURE more or less immediately, while the Next Generation Europe will kick in more slowly. But in a sense, this is deliberate because they address different time horizon, they address different problems. The main risk to me is again in the mechanisms that could become too bureaucratic. Red tape is one of the typical illnesses in Europe, but it's not the timing that will hamper the recovery, the timing of the intervention that will hamper the recovery.
Well, Domenico, I mean, it's so interesting listening to you. I try to share with my colleagues in New York a number of questions and views regarding the relationship, even of the United States with the European Union. 2 weeks ago, we were very close to a threatening breakup. And then we have to say again, Germany with France, and of course Italy was behind them, we found that the leadership to lead the situation, it looks like to a safer way. But why you think, especially with the recent US leadership, they look as a united Europe an issue? Because it looks like they want to break. United States has some interest. Difficult to understand from me, but I think your point of view, you are, of course, the leader, a US powerhouse. So your opinion is extremely valuable to us.
Well, this is truly an excellent question, Andrea, because it seems to me that the European initiative by Merkel and Macron was somehow the consequence of the German Constitutional Court ruling on ECB, the Karlsruhe ruling, as well as the protectionist stance by the US administration. Because Germany, for the last 20 years, has been imposing over Europe a specific business model where they were repressing somehow internal domestic consumption and domestic investment in European countries to have as many resources as possible for export. Once protectionism, as well as China's slowdown, is putting this export-led model at risk, then you need a strong inter-European domestic demand, because otherwise you will end up in an underconsumption trap. So both because of the Karlsruhe ruling, and because of the protectionist stance and the Chinese slowdown, etc., Merkel and Macron were somehow forced to modify dramatically the the business model, changing fiscal policy and changing as well the policy mix within Europe. That's the way I see it, at least. Furthermore, and this is interesting, even the US administration, I came with a council for the US and Italy at the White House when President Mattarella went to the state visit to the US last fall. Well, they recognize they need a stronger Europe. They cannot break up everything and pretend to thrive. So in a sense, there is some alignment of stars in that respect.
It's so interesting. Let's switch a little bit. I don't want to hammer too much about.
Don't forget the banks. Huh? I changed the topic, but I promised to discuss the banks as well.
Yeah. What will be the impact on the global financial worlds? COVID-19 will impact. It will require a heavier restructuring in the major banks. What's your view?
Well, again, you must distinguish the short run and the medium-long run. In the short run, COVID-19 will increase the size of the non-performing loans in the bank balance sheets because many clients will go bust. It will also increase the cost of credit, etc., etc. In the longer run, again, I'm a big fan of enhancing and changing the, how would I say, the channel between savings and investment, and the banks must be prepared to boost as well the capital market channel along with the credit channel they provide themselves. So there again, we will need some better banks, not necessarily European, but we will need them. I finished them.
I can jump in here with a question about Europe and China. And specifically, we have a question from the audience about Italy embracing the Belt and Road Initiative, and would this continue? So maybe a little bit about Italy and China, and maybe even broader Europe and China.
Yeah, I was in China when the Belt and Road Initiative was launched, and it was something different at the time. It was a big infrastructure program, maybe somehow imperialistic, I don't deny that, but it was fundamentally a brick and mortar or concrete plan. Since then, and that was about 6-7 years ago. Since then, the program morphed because China business model morphed. China at the beginning was a country where the production was mainly concentrated on low productivity goods and services, and it quickly transformed into, climbed up the value chain, if you want, with higher technology, immaterial goods, etc. And this is one of the factors, on the one hand, which changed the Belt and Road, on the other hand, which boosted the tensions with the US, because they now compete on more, you and China more compete on the tech goods and services. 5G is the clearest example. So why did we join? Because we wanted to open up our capital and our infrastructure, etc., to the Chinese, and then it morphed into something more pervasive. And honestly, I don't know exactly because these are not public information, but I believe, so, sorry about that, but I believe we didn't take yet the main decision on the 5G, which is the next frontier of the Belt and Road.
Thank you. Andrea, do you want to ask the next one?
Yeah, I would like to ask you something with more international perspective. I see that, especially in the US, they perceive, and maybe it is in a very confrontational way, the relationship with Russia. I believe Russia is very active in the foreign policy, but its financial backbones and industrial situation is pretty weak and fragile. If at the end we will have two main countries like China and the United States, what will be in the future, in your opinion, the role of Russia?
Well, you said you mentioned the fundamental data around Russia is not an economic superpower. It is a military superpower, and it is diplomatically very savvy. If I think the way in which they act in Syria, for example, as in many other places, I believe they have a first-class foreign policy. The problem is that it's a delicate balance, because if we close the door completely to Russia, Russia will be pushed towards China, which is not, by the way, their first choice. So we have to keep them in the game without opening too much and without closing too much. That said, for many years we discussed about the G2, which was US and China. I believe the economy should be run by a G4, which is China, US, Russia, and Europe. Europe, and this goes back to one of the debates I had with the Chinese leaders, Europe needs to be united. If it's not united, each of the European countries is too small. And therefore, we need, these institutional changes, like the creation of a true political union and federation, requires decades. But it's somehow a destiny we must follow. Otherwise, we'll end up into it's not needed somehow, but if we want to have a role in the global scene, we need to be united. Paradoxically, having lost the UK, we didn't even mention the word Brexit, but having lost the UK made easier for Europe to brace, because we are more homogeneous somehow, but there's still a long way to go.
Well, this is a fascinating subject. I strongly believe that Europe, for its tradition, and its culture, is the perfect crossroad and ally for United States to establish a so-called Atlantic policy. And for sure, Russia, they like to talk to us, European, who are neighbors. It's a much easier way. So I believe that the centrality of Europe in the global policy chessboard is very, very important. It could be very, very helpful to United States. So of course, we are European, you and I, but we have our kids in the United States. So we strongly believe in this legacy, even in the future. Can you tell us what is
if I may, Andrea, don't forget the fact that the capital market is still in Wall Street. And as the global growth need the wholesale banks that move capital from surplus countries like China or Asia to Europe and to the US. We need this sort of globalization. And if you look at the debate on protectionism, no one put financial protectionism in play yet.
You mentioned just one more question about another giant very close to United States, is Brazil. What do you think COVID-19 will impact on the South American economies, and especially Brazil, who's potentially by resources and his ability to grow has a special role, a special position in it?
Well, if we are not naive, we must recognize that the management of COVID is highly political, let alone the US, where there is the election, the general election, the presidential election, in November, but anywhere from the UK to Italy to France and to Brazil, politics played an important role in the management of the crisis. If you look statistically at the position of the different countries, the populist governments were somehow reluctant to recognize the pandemics. And Bolsonaro has been one of the latest in recognizing them, that's the COVID, and that can easily backfire. So the delay, there is a recognition lag mixed with politics, can create a stronger and deeper and more negative impact on COVID, but also can have in turn political repercussions. So I'm not an expert in Latin American politics, but it may backfire.
Donna, you have, yeah.
Yes. Earlier in your talk, you mentioned, realistic optimism. I'm curious if you could share for us, what you think has to happen over the next few months for things to really turn around economically.
Yeah, well, first of all, politically, I believe that political decisions, even the crucial ones like the creation of a more federal Europe, etc., are the product of structural pressures on European leaders. So I'm not desperate about that. Anything can go sour. I don't know who will be the next leader in Germany. Anything can happen, but it seems to me pretty well channeled in the right direction. What can influence the real economy, of course, will be the policy response, because you can have a strong and an important support to consumers and firms that are in financial distress. You can have big investment plans, and more importantly, partly exogenous to us as bankers or economists, is the resurgence of a second wave of COVID, which would be totally detrimental to growth. So we'll see. I'm also a bit scared about the big global protectionist wave, because I don't know if you've seen it. There is a very recent article last week, newspaper article by Ken Rogoff, which says that deglobalization may go too far, and in that case, it's dangerous. So we'll see. I mean, history is always a complex process. It's very difficult to predict anything, but it seems to me that this terrible COVID pandemics could act as a positive catalyzer for many changes that could take ages. I mean, take even marginal issues such as the real estate. We'll need to change our houses, and we'll need to change the structure of our offices. We are making the changes which were already underway, or even new changes which were not foreseeable, accelerated dramatically over the last 4 months. And in many, think of work from home. I mean, we progressed by 10 years in 4 months, which doesn't mean we'll go ahead like this forever, but certainly I'm impressed by the pace of the change and the global nature of the change, because the big crowded office or the big crowded tube will not, are not up to date anymore.
One of the things that's near and dear to my heart is higher education. We're seeing an accelerant of change. Do you have any comments on where you see higher education in Europe and in the United States?
Yeah, well, higher education and education in general, university, have been hit severely by the pandemics. I sit in the board of the HEC in Paris, which is a business school, and I'm in the president board of NYU in your town. Everybody is under deep uncertainty, and probably next year will not reopen. Next year means next September. And this, in my opinion, is terrible, because university is fundamentally a community experience. I mean, you exchange ideas much. It's not about giving instruction on the web, but it's about interacting, discussing, challenging. And in that respect, I'm honestly concerned, because we cannot have new outbreaks of virus in universities, of course, but we cannot imagine a future without education in presence. So we'll see. In Europe, it's equally very cautious. So Cambridge, where I got my PhD and I received their emails, will not reopen in September until year end, solar year, not the academic year. Paris as well. So it's very complex.
Indeed, but one of the benefits is our ability to have wonderful guest speakers like you visit all of our courses. So that is one benefit. So students are getting a chance to interact with very high level thought leaders.
Andrea, next time I'll come live.
Yes, we welcome that. It would be wonderful. Andrea, maybe you want to ask one more question and then.
Well, I mean, having this privilege to have Domenico with us stimulates a lot of thought. I would like to take the opportunity to use one of the questions that was raised by one of the attendees. So I don't feel in a conflict of interest because the question is about Italy. Do you think that raising our debt GDP ratio to 170%, it will never be recovered? So we will see a durable high debt situation in Europe, because this is not Italy. France is supposed to arrive 140, 150. So what do you think will be the final? You said smartly, you said a decade. What will happen after these decades?
Well, if you look at history, these big debts are never repaid. They are reduced by means of growth, by means of inflation, but it's very, very hard to repay a debt above 100%. If for the time being, or at least until the interest rate will stay very low, not necessarily close to zero, but very low, you end up in a Japanese situation where public debt is managed, even if it is above 200% of GDP, because if you don't have to repay because it's easily rolled over by the central banks and other buyers, and if you don't have to service the debt with high interest rates, then it can go on. Finally, the fact that all countries have a high public debt. Of course, I didn't talk about the wealth tax because I believe it's crazy. because it destroys the base without solving the problem. But over and above that, I believe that having a situation where all the countries have debts skyrocketing, irrespective of the fact they have reserve currencies or not, etc., makes the situation easier, because the solution will be a solution for everybody. While if you are the only black sheep in the pack, then you are in much more real problem. That's in a sense is the example of Greece last time in the last crisis. So we have to live with the high debt for a while. We don't have to think about reducing the high debt for a while. But I believe they can be managed until the situation like this. But I believe the situation eventually will be general. Could be a big wave of inflation. I don't see a big wave of growth, to be honest. But could be something we don't see, because it's typical of economists, bankers, CEOs, leaders to miss the next problem. I was in Davos in January this year, and of course we were talking about climate change. We were talking about inequality, which is very important. We were talking about all the different issues. No one ever mentioned the pandemics, even if it was already present in China. And 1 month later, we were in a collective nightmare. We could not even forecast 1 month in advance.
Donna, we can never, with Domenico, we can start talking. It's the only way is to have him at dinner, for a couple of dinner at least, with some good Italian wine, because in every subject we can have a wonderful insight and an opinion who let us understand better how complicated is here now the world.
Absolutely. Thank you so much, Domenico. Such really important insights into a very complex world. I want to now invite my colleague, Andrew Auslander from the CFA Society, to close the session and tell us a little bit about the CFA Society. So Andrew, please, welcome.
Thank you. Thank you, Donna. Hi, I'm Andrew Auslander. I have the honor of being co-chair of the Value Investing Group at the CFA Society of New York. I want to thank everyone who made today possible. Thank you very much to Andrea Manilo. You did a great job of interviewing Mr. Siniscalco. I want to thank Domenico Siniscalco very much. He provided great comments on the future of European institutions. I want to thank Donna Rapaccioli, Dean of the Fordham University's Gabelli School of Business, for your leadership in creating the Centennial Speaker Series. A big thank you to Fordham University's Gabelli Center for Global Security Analysis for hosting today's event, and to the Museum of American Finance for their generous sponsorship. The CFA Society of New York has been bringing unbiased content and education to finance professionals for over 80 years. We have more than 11,000 members and many thought-provoking events every month. You do not have to be a CFA charter holder to join the society, and you receive a discount to almost every event. If you're interested, please visit cfany.org for more information. Thank you and have a great rest of the day.